Happy Monday, everybody. Today is April 6, 2026, and this is your Monday market update. Now, we're coming off a week that felt like a tug of war between relief and reality. Markets tried to price in the end of a geopolitical event, while at the same time reacting to the fact that it's not over yet. Add in a holiday shortened week, quarter end positioning, and a jobs report that came out while markets were closed, and you had a setup that led to sharp moves, but not always a clean direction. Let's get to the markets. Let's recap last week and let's preview this week ahead. To start the week on Monday, markets opened higher on headlines suggesting progress towards a potential resolution in the U.S.-Iran conflict, but that optimism faded as oil prices surged back above $100 per barrel, reinforcing inflation concerns and pressuring equities. As the day went on, oil became the dominant driver and stocks gave up their early gains, with tech leading the downside while defensive sector held in better. The Dow was up just over 0.1%, S&P down about 1/3%, and the Nasdaq was down roughly 0.75%. Then on Tuesday, the tone flipped entirely. Markets surged on renewed optimism that the conflict could wind down, with reports pointing towards a potential diplomatic path forward. That sparked a sharp relief rally and a meaningful short squeeze into quarter end, leading to one of the strongest sessions we've seen in months, with broad participation and tech leading the move higher. The Dow was up about 2.5%, S&P up nearly 3%, and the Nasdaq closed up 4%. Moving into Wednesday, markets continued higher, but with a more measured tone. Investors leaned into the idea that a resolution might be approaching, while also digesting mixed economic data beneath the surface. Oil pulled back slightly, which helped support equities, but there were still some underlying concerns in the forward-looking data, even as the headlines held up. The Dow was up about 0.5%, S&P 500 up roughly 0.75%, and the Nasdaq was up just over 1%. By Thursday, volatility returned in a meaningful way. Markets opened sharply lower on rising oil prices and more aggressive rhetoric around the conflict, with major indices down more than 1 or 2% intraday before staging a strong recovery into the close. That kind of reversal does tell you positioning is still light, and investors are reacting quickly to headlines rather than stepping in with long-term conviction. The Dow was down about 0.1%, S&P up just over 0.1%, and the Nasdaq was up roughly 0.25%. Markets were closed on Friday for Good Friday, but importantly, the jobs report was released, and it was stronger than expected. The economy added about 178,000 jobs in March. That was roughly 3 times what people were expecting, while the unemployment rate did tick down to 4.3%, reinforcing the idea that the labor market remains resilient. From a market standpoint, that creates a bit of a push and a pull. On one hand, stable labor market supports consumer spending and corporate earnings. On the other hand, it reduces the urgency for the Fed to cut rates, and in fact pushed Treasury yields higher immediately following the report as expectations for rate cuts were scaled back. Now, because markets were closed, we have not yet seen a full equity market reaction, which makes today's open especially important as investors digest both the strength in the labor market and what it means for the path of interest rates. For the week overall, despite the volatility, markets did finish higher and snapped a multi-week losing streak as easing yields, quarter-end rebalancing, and hopes for de-escalation supported equities. The Dow was up about 3%, S&P up just over 3%, and the Nasdaq was up a bit more than 4%. Year-to-date, however, markets remain modestly lower. The Dow's down about 3.33%, S&P down about 4%, the Nasdaq down just over 6%. Now, you've likely been hearing the word correction more frequently. We talked about that last week. While the S&P did approach that 10% threshold from recent highs, it's important to remember that corrections are a normal part of market behavior and tend to occur every 12 to 18 months on average. What's more notable this time is that under the surface, certain areas of the market, particularly parts of tech, have seen more meaningful drawdowns, even while the broader indices have held in relatively better. Now, let's step back a little bit. 3 themes did really drive markets last week. First was geopolitics, with the U.S.-Iran conflict and the uncertainty around the Strait of Hormuz continuing to influence oil prices and investor sentiment. Second was inflation expectations, as higher energy prices kept markets sensitive to the potential for renewed inflation pressure, despite more measured commentary from the Fed. And third was positioning, with quarter-end flows and short covering playing a meaningful role in last week's rally. Now let's look ahead to this week. The focus shifts back towards fundamentals, but geopolitics still firmly in the background, if not really the foreground. From a data standpoint, we start the week with ISM services, followed by durable goods tomorrow, which is expected to show some softness tied largely to aircraft orders. The Fed will also be in focus. The Chicago Fed President Goolsbee and the Fed Vice Chair Jefferson are both going to be speaking, particularly around how rising energy prices may impact their inflation expectations and policy decisions going forward. Now, midweek, we are going to get the minutes from the March FOMC meeting, where the Fed held rates steady, but maintained a slightly more cautious tone around inflation risk tied to energy, while still still projecting a gradual path towards eventual rate cuts. Now, the recent war with Iran had already started when they had this meeting, so it's going to be very interesting to see if they had any comments on that. As we move later into the week, inflation becomes the main event. PCE on Thursday and CPI on Friday, where expectations are for a meaningful increase driven in part by higher energy prices. At the same time, earnings season begins to come into view, with early reports from companies like Delta and Constellation Brands offering insight into consumer trends, and the unofficial start of earnings season with banks coming next week, all while markets continue to react to any developments out of the Middle East. Now, the bottom line is that last week was a reminder how quickly sentiments can shift, but also a reminder that markets do not move in straight lines, especially in environments driven by uncertainty. This week adds another layer as markets now have to digest that stronger than expected labor market alongside rising inflation pressures. And of course, the ongoing geopolitical risk. Stay focused on your plan, not the noise. Have a great week, and we'll see you soon.